50-to-1 leveraged on some things. And it just seems like it's just preparing for everything to come crumbling down at some point, unless those reports are very inaccurate. I'm not sure if you've seen anything along those lines.
I haven't seen those particular numbers, but I do feel that, banks, we were in that situation, obviously, in the great financial crash in 2006, 2007. I think, liquidity ratios and capital ratios were tightened after that. To my knowledge, they've been loosened a bit in more recent years, which to me is a huge mistake. I believe banking should not be a casino. Banking was all about borrowing and lending money, and the primary function of a bank was to be the middleman and make the economy function that way. But obviously, we've seen over the years that banks became much more involved in trading and risk-taking, and it became a casino. And in some respects, maybe it still is. Maybe not to the same extent as 2008. And I would think that whatever the numbers are, they may not, whether they're the numbers you've mentioned or not, I'm not sure. But I think it still is a big risk. And again, I don't know if you're familiar with the Archegos story, which was a massive fund who had money with Credit Suisse and several other banks. And they were kind of a non-bank. But the impact, I think Credit Suisse lost something like $4 billion, if not more. And several other banks
I've heard
similarly damaged. How many more Archegoses are out there? We don't even know. I would think that in an ideal world, banks would be a lot more limited in what they could do, especially when it comes to, depositors' money. I mean, we did have a situation in the past where investment banks and commercial banks were totally separate, and only commercial banks were insured by the Fed, the FDIC, and investments banks were not. And that was different, because then if you put your money in an investment bank, you knew the risk you were taking. But then investment banks were allowed to merge with commercial banks. We saw that, and then so the taxpayer had to come to the rescue when they all lost their shirts during the great financial crisis. And that may happen again. Janet Yellen came out saying about a year ago or less, she didn't believe there would be another crisis in her lifetime. And the reason she said that was she wanted to loosen the capital rules. I certainly think she's going to be wrong.
Yeah. Not a fan of Janet Yellen. She and every other politician has taken obscene amounts of money from Wall Street. And I just feel it's very difficult to regulate someone when they're paying you for a speech more than your annual salary from the federal government.
Well, that's funny. That's exactly what I was going to say. I mean, if you've heard Janet Yellen speak, how much would you pay for one of her speeches? And then you look and see what she is being paid, like something like, if I saw the numbers there, I remember there was a LinkedIn post, and I think it was something like between $300,000 and $700 per speech. So, you have to say there's no such thing as a free lunch. Why are people paying that amount for a speech? And you can draw your own conclusions. Just as I know, one of the other things you had planned to mention was payment for order flow, by the hedge funds or the high frequency traders. Likewise, there's no such thing as a free lunch. Why would they pay Robinhood and the other, commission-free brokers money for all that flow? There's only one reason, so they can make even more money than what they pay. They're there to make a profit. There's no other possible reason. And they can front run the market. I'm just reading a very good book, actually. I read the book. You've probably seen that one, Flash Boys, Michael Lewis. And the one I'm reading at the moment, which is The Flash Crash, which is a fascinating one. I'm about 3/4 way through it now, about the flash crash and how this guy crashed the whole market working from his parents' bedroom in a house in London, And it was all about the spoofing, if you're familiar with spoofing, putting in spoof prices that he never intended would. And he set up a kind of a computer program so the prices would always be a couple of ticks too far away to actually be hit. But he was putting in like 300,000 prices a day. He was responsible for something like 30% of all the outstanding contracts, this guy in his bedroom. Extraordinary. But, so that's, when you look at Robinhood and you look, again, the retail traders, it's the same people to a large extent who are in crypto, who are in GameStop, who are in AMC and so on. And I feel that these big hedge funds like Virtu and Citadel and all these guys, they're just there milking them, And okay, now and again it goes the other way and the little guy wins. And I know everybody loves that. The little guy wins because they put on a big short squeeze. But what bothers me is the rationale for what they're doing. They're not buying GameStop because they think it's a fantastic company. They're buying.
Oh, well, I beg to differ, actually, on GameStop by itself. So I agree with you on a lot of the other companies, on AMC particularly, but on GameStop, because I have been so heavily in depth in the community of people who have been buying and continuing to add to their positions on GameStop. The fundamentals of that company are something that the community, whilst many of them might have got involved for the reasons that you're saying, the reason that they're still there and the reason that I am still invested in it actually as well is because I actually believe the company is making really, really good moves in terms of they've paid off all their debt. They've got 1.7 billion in cash to spend. And the digital transformation and the hiring that's going on is absolutely stunning. The amount of ex-Amazon and Google executives that they have brought in is amazing. Their online store has been transformed over the past 9 months since Ryan Cohen came in. So on that one specifically, I will disagree with you. But the sentiment about the rest of it, I do agree. And it's something. It's basically a sentiment that you expressed earlier about how people are treating Wall Street in a way. It's gambling. It's a casino. I think was the term you used, and that's very much the way that a lot of the people, especially who got involved in trading on Robinhood, look at it. Look, Wall Street has been doing this for decades. They've been treating it like a casino. So why can't we?
I think in a way, the answer in some respects is you're betting against the house and the house always wins. The problem is if you're betting against people who have a lot more information than you have and who have the inside track in a lot of ways, it's very difficult. I think the whole concept of, swarming over a particular stock and so on, it's maybe smart from a pure gambling stroke trading point of view that you can get enough people, but everybody's got to keep ranks and so on. And you're talking about hundreds of thousands of people as far as I can see. But the problem is if the valuation of the stock doesn't hold up to the level you've brought it to, you have a massive risk. And that's what I would feel. I would probably differ I can understand the rationale you've mentioned with regard to GameStop, and you clearly know a lot more than I do because you're following it in detail. You're connected with that community. I'm not really connected with that community other than a few skirmishes on LinkedIn. But I suppose I would feel they've got rid of their debt because all of these people have bought their shares at very high levels and they've been able to issue. And that's a smart move. That's a smart move. Of course it is. Yeah. And they're making, I wouldn't disagree that they may be making good moves. Again, you're closer to that than I am. But, whether they will make enough money over the medium term to justify the kind of valuations that are on the stock, that's where I might be a bit more skeptical.
Thanks for making it all the way to the end of the podcast. Don't forget our sponsor, ExpressVPN, and my book, Brexit, the Establishment Civil War, can both be found in the links in the description below. And also, please like, share, and subscribe to this podcast. It's the best way to help us grow. Until next time, thanks for listening. Screw the hedge funds.
You can make as many rules as you want, but if there's no teeth behind them, what's the point?
Well, Citadel is potentially just gone in a few months. It feels like financial institutions, that they are all laughing at us by buying GME. Screw the hedge funds. I will lose my entire investment if it brings them down.
Why on earth last May, could you buy the entire company for $200 million?
What's been happening on Reddit and in social media and in the marketplace has never been seen before.
I argue that nothing is off the table. There is nothing off the table when dealing with the volumes of money in something as big as the United States stock market.
The hedge funds have clearly underestimated a group of people raised on Friday night World of Warcraft raids.
Dark pools, they're another mechanism to manipulate and cheat. Mainstream journalists don't say these things for a number of reasons. One is their sources are the people that I'm talking about, and so they can't call somebody a crook.
Superstonk and the other communities that have emerged are a hive mind, the likes of which we have never seen before. It's madness and brilliance, insanity and genius all rolled into one. It's very possible that Citadel will be gone in a few months. And not just Citadel, but the entire financial system has the potential to come crashing down. These crooks continue to gamble recklessly with the world economy, and this could be the moment that they finally get their justice.